The world is falling apart. All major economies are at the forefront of their biggest crisis ever. But how did this all come about? When did the problems start? And what made them so big in the first place? And what does the future hold for us? In this video, we'll go through the last 20 plus years of financial history, and we will talk about all the things which led us on the path to such credit expansion and high debt levels. Before we start talking about the current and future economic and financial problems of the world, it is best to give some background about what got us here in the first place. In order to be well prepared about the future, you must first understand the past, because everything is a part of cycles which may not repeat identically, but they do rhyme quite easily. Hello friends, and welcome to the Market Watcher, a place for gathering traditional financial and all other investment knowledge on a regular basis. Subscribe to the channel, like the video, and hit the bell icon so that you won't miss out on any of our valuable upcoming content. As always, everything said in this video is with educational purposes only and should not be considered to be taken as financial advice. In general, the main problems of the world could be bundled up in three words: excessive debt burdens. All around the world, all economies are indebted up to their necks with credit. Ever since 1971, when President Richard Nixon got the dollar to be depegged from the gold standard. Nowadays, all that stands behind a currency is debt, and this move made all other nations adopt this new monetary system. All currencies from that point on started to become so-called fiat currencies, which means currencies that have no real backing. On the next chart, we can see how the global debt level started to rise significantly after 1971. The chart is provided via the International Monetary Fund. With yellow, we see the public debt, which means the government's debt, and at the end of the day, that debt needs to be paid for with taxes from us, the public. After that comes household debts, which include car loans, home loans, personal credits, and so on, and the dark blue line shows the non-financial corporate debt levels. Definitely the highest increase is seen when looked at the yellow line, which means that governments are the biggest spenders. In 2020, the world saw the largest debt surge in 50 years. Now the world is standing at the incredible more than 256% debt to GDP level. This amount of debt is incomprehensible, it will never be paid off, and for some more context from a historical perspective, there was no organization or nation state which has ever had a debt to GDP ratio of over 130, which has not hyperinflated or had a severe depressionary debt spiral, destroying the economy and with it the prosperity of the nation. The current moment in financial history is often expressed as the everything bubble. Each one of the previous three crises has led to a stitching of the balloon instead of letting it go down. Central bankers around the world pump up the balloon even more, and it starts to encompass other asset classes. Let's explain this in a bit more detail with some history to back it up. In the year 1999 to 2000s, we saw the popping of the so-called dot-com bubble. This bubble was a massive bubble in the United States technology sector. On the S&P 500 PE ratio chart, we can see that in 1999-2000 the ratio was around 45, with the average being 16. This was almost a 3x overvaluation from the average, which is insane. Even during the peak mania in late 2020 and early 2021, we did not see such a level. Then the PE for the index went to about 38, which is still quite high and insane. Even during the greatest stock market crash in history in 1929, we had only a level of 30. So around the 2000s, a stock market bubble had popped. Due to the high financialization of the United States, something had to be done. High financialization means that the majority of the population of a country is invested in the stock market or is engaging in some sort of investment activities. In layman's terms, when you have a high financialization, the economic mood of your population is in contango with the direction of the financial markets. When the markets are going up, everyone is happy. When the markets are going down, people stop spending, economic growth lags, and people often turn on to the government for help. This is why after the crash of the stock market between 2001 and 2002, President George W. Bush came out and stated that the American dream of owning a home is dying and the government needs to help. At that time, the then president of the Fed, Alan Greenspan, lowered the Fed's interest rate down dramatically. Also, a new type of loan called NINA loan was established. It stands for No Income, No Assets loan. This is an insanity, but it worked. The severe crash of the stock market did not lead to a severe recession because credit became really cheap and accessible. People started to buy new homes with it, and with that, their economic mood started to get much better. This led to a massive rise in home prices, which made people rich from non-economically productive activities. Yet again, the financialization of the United States made its citizens feel quite good. What happened after this was quite obvious. The real estate market underwent a massive bubble, but also the stock market yet again entered the bubble territory. Now we see the same thing in September of 2022. Bank of America came out with a statement that they are starting to offer zero down payment mortgages to customers, which is incredible yet again. When a buyer can buy a home with no down payment, he has no financial risk. This leads to a lot of speculatory decisions, and in turn the boom and bust cycles get bigger. The year is 2007-2008, and the financial markets around the world felt the monetary expansionist policies of the United States. The so-called global financial crisis has started. The wheel turned one more time, but this time the world needed a bailout for all financial institutions and the majority of the firms worldwide. All economies from the US to Japan to China started to print enormous amounts of money, which were given out as credits at record low interest rate levels. This did not stop for almost 10 years straight, from 2008 up until 2018. All major central banks around the world had incredibly low interest rate levels and huge quantitative easing mechanisms in place. Around the period of 2018, the Fed tried to lower its balance sheet, as we can see on the provided chart straight from the belly of the beast, the Federal Reserve's website. As you can see, from 2018 up until the end of 2019, the Fed was slowly lowering its accumulated assets over the last 10 years. But even before any health crisis had occurred, they started printing money. This proves that even without a health crisis and the subsequent war escalations in Ukraine, a new crisis was emerging. All later issues were just bonus spins which made the balloon deflate faster. The 10-year stretched out loose monetary policy up until 2020 led to another massive bubble. This time the bubble was in stocks, real estate and bonds. The bond market is artificially suppressed in a tremendous way. When the central banks print money, they buy mostly bonds. With this money, these bonds finance the governments of different countries. If the printing and buying of bonds stopped, this would massively lower the demand for bonds and hence their yields would start to go up. Because in order for a person to buy a bond, he needs to have a higher yield. When more demand enters the market, bonds are being bought, which makes their price to go up and the yield drops. When no bonds are bought, the opposite happens. The prices start dropping, which brings the yields up and the bonds then become more attractive for investors. The problem is that these bonds and their yields are a debt burden for all governments and corporations. As we saw from our first graph, all debts are at a record high. This makes it so that if the yields start to increase, the corporations and governments alike would not be able to repay their debts and massive defaults would start to occur. This is why the system is often called a Ponzi scheme, because the money printing cannot stop. If it stops, the system will come to a quick and dramatic end. Old debt burdens need to be repaid with new debt burdens, but this leads to a lot of debt accumulation. At some point, the debt becomes so big that if the interest rate level is even a little bit above the 0% mark, the monthly debt repayments become impossible for repaying. A lot of people ask the question, well, if for the last 50 years money has been printed and no real problems have happened, then it is probably not that big of a deal. These people need to understand how debt repayments work. If you double your debt today, but at the same time your interest rate drops by 60%, you are left with lesser debt repayments than before you doubled your debt. If you triple your debt, but the interest rate drops by 90%, then again you will have less debt repayments in nominal terms. But this does not mean that taking on such debt is okay, because at some point the rate levels can increase. Nowadays, globally, all rate levels have started to increase due to inflation. This is why the central banks are between a rock and a hard place. They have huge debt burdens, and because of that, rates cannot increase. But at the same time, the inflation is rampant and rates must increase, because this is the best remedy for lowering the price increases. Or in other words, lowering the inflation. As all great investors like Ray Dalio, Charlie Munger, Stanley Druckenmiller, and many more say, the times are unprecedented and no one knows what the outcome would be. The best thing one can do is stay informed about the latest trends and stay informed about the most important information. This is why we started this channel, so that you can have the best and easiest to understand knowledge on a regular basis. So subscribe, like the video, leave a comment, because I read all the comments. And with that, I want to thank you for watching until the end. Goodbye for now, and I'll see you in the next video.